Real estate agents need to get inside the minds of their clients. To know which properties to present, it becomes essential to understand how investors think about real estate and the investments they want to make. The more effective an agent is at understanding this, the more likely that agent will be able to continue to work with and impress real estate investors in the area. At the end of the day, the investor is looking for real estate that provides the highest rate of return on their invested capital. This is then balanced with the right level of risk, which ultimately they define. It sounds simple, but navigating hundreds of property listings to find the best matchup for your client is not always that simplistic. First, consider risk, perhaps the hardest component to the process of selling to investors. Every investor is going to work hard to manage his or her risk. Risk, in this instance, can be defined as the ability of any property to actually produce an expected cash flow, profit, or value to the investor. That's not to say that investors are always on the lookout for low-risk properties. In fact, many of the most lucrative and successful real estate investors focus instead on properties that offer the greatest level of potential reward. And that comes with higher risk. In real estate, often the higher the risk a property is, the higher the potential for returns. And, when selected properly, the higher the expectations of the buyer. How do you know how much risk is present then? There are a variety of factors that can provide insight into this information. For example, cap rates are often a good indication of risk. Cap rates, or capitalization rates, are a ratio of the net operating income, or NOI, of a building, divided by the value of the property. For example, if the property is on the market for $2 million and it generated a net operating income of $200,000, it would have a cap rate of 10%. The higher the cap rate is, the higher the risk is. The lower the cap rate, the lower the expectation of risk. A lower cap rate on a property will produce a higher valued property. That's because the investor will pay more for the reduced level of risk present. In short, the lower the cap rate on a property, the higher the value of the property. A multifamily property that is in a less than desirable neighborhood is likely to have a higher cap rate. This means it has more risk. The higher cap rate will lead to a lower purchase price. Next, let's consider the time value of money. The time value of money, or TVM, is an essential component for evaluating all types of commercial real estate listings when the buyer is an investor. This concept holds the belief that money in hand, or money that's available on hand, is more valuable than money that is given or earned in the future. A simplistic example is this. If people were given the choice to receive $100 today or $110 in a year from now, most people would rather receive the $100 today. Investors can use this information as a way to measure and project the overall profitability of any type of real estate. This is important to most investors who are considering mid- and long-term investments in property. In short, a buyer needs to consider if the future potential earning of a property is worth more than having money in hand right now. Is it worth the risk? Cash flow that's earned in the future will be worth less than cash in the present, which means these cash flows are discounted at the minimum rate of return the investor is willing to take. This discount rate helps the investor to measure the net present value of any property. There is also the concern of liquidity. Real estate in general is an illiquid asset. There is no easy way to sell property fast to recoup the investment. This is very much unlike stocks, which can be sold quickly on the stock market when there is a need for cash on hand. Keep in mind that many investors do not see their real estate as this type of investment and do not expect it to be. However, they should know the market trends and understand expectations now and in the long term about the ease or difficulty of selling. Consider leverage as another important characteristic of real estate investing. Leverage is the use of borrowed capital, such as a mortgage, to increase the potential return of any investment. In other words, an investor is using another person's or company's money, OPM, to make an investment. This is a very important aspect of investing. It lets the investor increase their rate of return on any property, but comes at a cost, of course. For example, if an investor purchases property for $1 million using all cash and the property has a net operating income of $80,000, he has a solid 8% return per year on the money he invested in the property. However, if that same buyer purchases the same property using a $750,000 mortgage, he only pays $250,000 up front. This reduces the amount of capital the investor has to provide. If that mortgage has an interest rate of 6%, that would mean a monthly mortgage of $4,500 or $54,000 annually. So, that $54,000 needs to be subtracted from the potential net operating income of $80,000. This yields $26,000. In this example, the investor's rate of return is 10.4%. Simply divide $26,000 by $250,000. This allows for the investor to grow his or her rate of return from 8% to 10.4%. Of course, leverage is not always a good thing. In this example, we see positive leverage. It helps to increase the buyer's rate of return on the investment. However, there is also the potential of negative leverage. It decreases the investor's rate of return. How is this determined? Simply put, when the cap rate of an investment is higher than the interest rate on the mortgage, you can expect that the investor will see positive leverage. Conversely, if the cap rate is less than the interest rate of the mortgage, this creates negative leverage. What's your job in this? Generally, agents will need to be able to understand each of these components so that they can provide insight into the profit potential of any type of investment. It may mean spending a bit of time working on math, but in the end, it allows you to help your buyer to see better results on any investment they make.